Hi friends, today we'll discuss about Silicon Valley Bank crisis. So in this video, we'll see what really happened to Silicon Valley Bank, what factors led to its failure. Is it really leads to the next financial crisis, which will happen in 2008, like Lehman Brothers collapse? What is the effect of the Silicon Valley Bank failure on Indian banks? How does it affect the current startup scenario? So all these things we will discuss in this video. Last Friday, the news became viral when this Silicon Valley group lost more than 63% of its share price. So it leads to the panic in the Indian stock markets along with the US stock markets. Mainly, these banking systems got severely affected because of this bank failure. So friends, we will see how this Silicon Valley Bank works. So for any bank, it takes deposits and gives lending. Lending and borrowing are the main activities for any bank. So the Silicon Valley Bank also do the similar type. So mainly it gives the lending to venture capitalists and private equity firms, or it can also give the lending to startups. So most of the the deposits also comes from the venture capitalists and private equity firms, and also from the startups. Here the important thing to note is most of the deposits of the Silicon Valley Bank comes from these venture capitalists and private equity firms or from startups. Friends, during COVID pandemic, the startup ecosystem was very active and healthy at that time. There are a lot of investments came from these venture VCs and PE firms into these startups. So what these startups have done, they invested into banks like Silicon Valley Bank. So most of the Silicon Valley Bank deposits came during that time. Here you can see during first quarter of 2020, the assets of total deposits of the Silicon Valley Bank is around $60 billion. But by the end of 2022, the deposits increased from 60 to $200 billion in the matter of 2 years. So there is a lot of deposit surge happened during that time. So what the Silicon Valley Bank has done is they invested all these deposits into government treasuries and mortgage securities. So you can ask me, these are the very safe or guilt-free investments. So why this Silicon Valley Bank crisis happened? Friends, this is an important question. So we will see what really happened to this bank in this video. Because of that market crash, customer tried to withdraw around $42 billion of deposits. It is all around equal. It equals to 25% of total bank deposits. So the bank ran out of cash. So the news was Silicon Valley Bank sold long-term securities worth $21 billion. At a loss of $1.8 billion because of the decrease in the bond prices. Friends, the one more important thing is the Silicon Valley Bank. I already told it invests in a lot of startups, right? So one of the its initial investment was in Shadi.com, and the Silicon Valley Bank, it also has an Indian branch in Bengaluru. So friends, the next question is why it has to sold the long-term securities at a $1.8 billion loss. To understand that, we need to understand this relationship between the interest rate and the bond yields. So before that, when you see these US government bonds or 10-year yield interest rates, during pandemic times, to boost economic activity, the Fed it kept the interest rate very minimal. During that time, these 10-year bond yields also are very low. It is at almost 0.5%. But slowly after 2022, because of the inflation, US Fed tries to increase the interest rate, mainly to decrease the inflation. So the interest rates are kept increasing high and high. It almost reached 6%. These interest rate and bond yields are directly related. So along with the interest rate, the bond yields also increased. So when the Silicon Valley Bank invested in bonds, the bond yields are only 1.8%. But currently, the new bonds are carrying a yield of around 3.9%. This is one of the primary reasons why Silicon Valley Bank sold in these securities at a $1.8 billion loss because of the fall in these bond prices. To understand that, we need to know the relationship between the interest rate, bond price and bond yield. So here I will try to explain in a simple terms. The interest rate and bond prices are inversely related. The interest rate and bond yields are directly related. Whenever the interest rate rises, bond prices will fall down because of the inverse relationship. Whenever the interest rate rises, the bond yields also increases because of the direct relationships. Friends, here I will try to explain with two simple examples. Let's say RBI introduced government bonds worth 1 lakh at a yield or interest rate of 8%. So it means 1 lakh bond carrying 8% of interest rate. When they entered into second market, based on the buyer and seller, so anybody can sell these long-term securities at any time. let's say RBI increases the interest rates. Now the same government bond is carrying the yield of 9%. The older bond is only having 8%. So what people tries to do, because it is having higher interest rates, everybody will buy these new bonds only. So the people who has these older bonds, they try to sell these bonds in the secondary market at lower prices. So the bond prices are available at cheaper cost than the original price, mainly to match these current prices. So the inverse will happen when RBI decreases the interest rate. So let's take example. So if the new bond is available at 7% of interest rate or 7% of yield rate. So now the 1 lakh bond is having only 7% of interest rate. The older ones is having 8% of interest rate. So most of the people, they go into the secondary market, they try to buy the older bonds. So there are more buyers available for that older bonds. So what happened is that people, instead of selling at 1 lakh, they sell the prices at higher than the 1 lakh. So the bond prices will increases, the bond yield will comes down. So this is a simple relationship. And I think you understand this concept, this simple concept between this interest rate, bond prices and bond yields. So for Silicon Valley Bank, it has invested more than 75% of its deposits in long-term securities. But at that time, the bond yields are very low. It is only 1.8%. But currently, the bond yield is around 3.9%. So from our last relationship, the interest rates are high and the bond yields are high for the new bonds. So there is a limited bias available for the older bonds. So what the Silicon Valley Bank has done is, since it requires, since there is a lot of demand for the deposit from the depositors, so it has to sell its securities at lower bond prices. So because of that, it has almost lost $1.8 billion compared to its original value. So to match that, what it has done, it's trying to raise the money through open market, but it failed to raise the money. And depositor came to this news that the Silicon Valley Bank is failed to raise an investment, and they rushed into this bank to take out their deposits. So it failed to provide them the money, and the operations are shut down currently. If the similar situation happens to India, what we have to do? So for India, we have a Deposit Insurance Credit Guarantee Corporation, which is backed by RBI. Whenever we invest in any bank, up to 5 lakhs of our deposit money is guaranteed by RBI. Means even if the bank goes bankrupt, if your deposits if it is less than 5 lakh, the whole money will be given by RBI or government. Similar thing is also available in US also, the Federal Credit Guarantee Corporation. So here they can support up to $250,000. But the problem here is that most of the deposits of the Silicon Valley Bank are from venture capitalists or private equity firms or from startups. So more than 75% of their deposits are not covered under that insurance guarantee scheme by this US government. So because of this bank failure, most of the people are thinking this can lead to snowball or ripple effect onto the financial system. It may have the chances of leading to the financial crisis which happened in 2008. Although this Silicon Valley Bank compared to JP Morgan Bank, it is very, very small. And there are more chances of US government come and try to take this bank out of this crisis. So all these events we have to see and watch carefully. And whenever you are taking any investment, be careful, friends. Try to hedge your funds during these events because we don't know when the backfire event can take place. So our main aim will be to protect our portfolio. Always try to have these stop losses during these events. So there are a lot of gap downs and gap ups will happen during these times. If you like our video and if you like our content, please like and subscribe to our channel. Thank you for watching.